Hello, everyone, and welcome to the seminar on scheme investments. My name is Mihir Tirodkar. I work at Russell Investments in our consulting team. Today, we're going to be talking about what I consider to be a primer for institutional investors. We'll be tackling a couple of points, starting with strategy and expectations, and then we'll move into the basics of various asset classes. So like I said, the overview of today's webinar session is to begin with what we consider a good investment process to look like. We'll then move into the traditional asset classes, which are typically considered to be cash, bonds, and equities. Leading on from this, we'll talk about portfolio construction and what a typical institutional investor portfolio, depending on risk and return objectives, should look like. We'll then move into related considerations on various other matters which can affect the performance of your portfolio and really should be thought about before creating a portfolio. We're going to start with investment process. This is typically what an investor should look at the beginning before creating their portfolio. So here we have a guide for what an institutional investor should do in order of operations when creating a portfolio. The first step is do. What we mean by do is to strategize. An institutional investor first needs to create a decision-making framework. What are the roles of everyone on the board? What are the trigger points of an institutional investor before they decide to rethink how they're going to do things? The purpose and goals of the portfolio also need to be clearly stated so that they can then be met. When we talk about purpose and goals, the investor must think about why they are investing. What is the portfolio going to be used for, and what are the returns and capital appreciation that it generates going to satisfy in the future? Furthermore, what are the risks that the portfolio might face, and is the investor able to take those risks? The investor must then look at investment choices. These often involve beliefs that need to be set before investing in order to ensure that conflict later on is not generated. When we talk about investment choices, we typically talk about various market phenomenon that an investor might not know the exact answer to, but nevertheless has to state what their beliefs are. Common ones involve market efficiency. Do prices reasonably reflect rational expectations of what might happen in the future? Another one is hedging. And another common one is whether or not to use active or passive managers. Lastly, an investor needs to, within the strategizing section of the framework, think about the diversification of risks. Diversification is something we will touch upon later in this webinar, but it is crucial that any efficient portfolio created needs to be diversified. If you aren't diversified, you're taking on a lot of extra risk that is not necessarily compensated. And that begs the question, why do it? There are many ways to diversify a portfolio, and within the do/strategize section of the framework, an investor needs to decide how this is going to be done. After an investment strategy has been created, an institutional investor will usually start selecting investment managers. What this often involves is looking at the universe of investment managers and assessing which one best meets the goals and purpose of the portfolio that have previously been set out. Common things that are looked at when looking at various different investment managers are the style biases that some investment managers might have, how far away they stray from the benchmark that they try to beat. Furthermore, what are the costs, the fees? These are all important questions and potentially the most important part of implementing a portfolio that fits the goals of an institutional investor. Lastly, finishing up the loop of this framework is the review section. An institutional investor must have an ongoing evaluation of their portfolio. What this means is have various trigger points in which if circumstances exceed those trigger points, the institutional investor can start reviewing and reevaluating whether or not their portfolio is successfully meeting their goals, or whether or not expectations and markets have changed and therefore the portfolio needs to change in order to meet their future goals. So we're going to move on to the traditional asset classes. When we talk about traditional asset classes, there are really three that people talk about. The first is cash. Second is bonds. Bonds are also sometimes called fixed income or fixed interest. These are terms that are used interchangeably. And the last one are equities or shares, also two terms that are used interchangeably for this traditional asset class. Now, why do we consider these to be traditional asset classes? There's a number of reasons. The first being reliable valuations. When we talk about reliable valuations, we really mean that we know what the value of a security within this asset class is typically around. The value of anything, remember, is the value that somebody is willing to sell at, which is met by another value that somebody is willing, the same value that somebody else is willing to buy at. We have large liquid markets for cash, bonds, and shares. And as a result, we have very live valuations of what these have previously been traded at. And due to this, we can reliably estimate what the value of our positions in these three asset classes may be, even if not perfectly, very close to it. These asset classes also typically have small unit sizes. This means that an investor with a smaller portfolio in dollar terms can still invest and don't need millions or billions in order to invest in these universes. Like I said before, there are liquid markets for cash, bonds, and equities. This means that if you want to buy and you've made up your mind, you can buy almost immediately. And similarly, if you need to sell in order to finance something else, the portfolio can be liquidated or sold down without significant delay or significant costs. There's good data on these asset classes. This means that we can research these asset classes and form reliable predictions or forecasts, I should say, of how they might behave in certain scenarios. We can run models on risks and expectations on these asset classes because we've had data on them for decades, and we know the various distributions that they're likely to follow in terms of probabilities, risks, and returns. There are also recognized benchmarks for all three of these asset classes. When we talk about benchmarks, a benchmark is a predefined set of rules which can be used to create a hypothetical portfolio within any asset class. And following those rules, we can know what we would have invested in. We can know what we would have returned if we had invested in following those rules. Typically, and we will get onto this later, and a passive manager seeks to replicate these recognized benchmarks within these asset classes, whereas an active manager seeks to outperform these benchmarks. The advantage of these benchmarks in these traditional asset classes is that we know almost immediately the performance of these asset classes as a whole. We don't need to do a deep dive and look at performance after doing valuations ourselves. This data is readily available and quite and can be quite expensive depending on the benchmark, but nevertheless, it is available. Now we're going to begin with cash. Colloquially, cash refers to currency, so the money we have in our pocket or the money we may have in our bank accounts. But within finance and capital markets, investing in cash generally looks a little bit different. It's not just money sitting in the bank account, and the reason for that is it's not really earning us any returns. When we talk about cash within capital markets, we are also talking about investing in money markets. Money markets are short-term debt instruments, which typically have maturities of up to 12 months, but are also usually much shorter. The borrowers pay interest and repay the loan, and as the lender or the investor in cash, we earn the interest and we get our loan back at the end of the maturity. So cash can be thought of as very low risk and also very low return debt. Typical borrowers within the money market include the government, banks, corporations, and some local authorities like councils. Like I said before, very low risk, but also very low return relative to the other asset classes. Is it risk-free? Well, the short answer to this is that no, it is not risk-free. Philosophically, if we think about risk, nothing is really risk-free. Everything has some sort of small probability of happening. And the GFC really did highlight this within cash, where many investors who were invested in cash, thinking it to be very low returns, were happy to see what they thought to be superior returns relative to expectations. The reason for this was many cash fund investors were investing their cash products and their funds within these products in asset-backed securities, which blew up during the GFC, and many investors lost their money. Moving on, we'll talk about bonds. What are bonds, or fixed income or fixed interest products? Bonds are long-term debt. Borrowers looking to raise medium to long-term capital issue fixed interest / fixed income or bond products, bond securities, and sell them to investors. The investors pay the face value, pay an amount in exchange for the face value, which is paid back to them at the maturity of the bond. In addition, they also get fixed coupons as a percentage of the principal. So a typical example of a bond would be if you were an investor looking to invest in the capital markets and buy a bond which has just been issued by a company. The company is offering $1,000 face value per bond and $10 of coupon interest every year. This bond would have, like I said, $1,000 face value and a 1% interest rate. That's $10 divided by $1,000, the face value. And that interest rate is called a coupon rate. Now, depending on what you pay for the bond, the actual interest as a percentage earned can vary. Intuitively, if we don't pay much for the bond, less than 1,000, the effective interest rate, or what is sometimes called the yield, can be more than 1%. If we pay more than 1,000 for the same bond, the yield will be less than 1%, which is the coupon of the bond. If we pay exactly $1,000 for this bond, which has $1,000 face value and $10 of coupon, we will be receiving exactly 1% as the yield as well. When market participants and commentators are talking about interest rates changing, they're typically talking about the yields changing, not coupons. Now, diving in a little bit deeper to yields. Why are yields important? Yields are synonymous with interest rates depending on the context of the conversation. When yields go down, immediately after, bond prices will go up. When yields go up, immediately after, bond prices go down. Let's have a think about why that is the case. If you were to buy this hypothetical bond that I just talked about, it has $1,000 face value, meaning that in X amount of years, you are going to get $1,000 back. And you receive $10 of interest every year, and you pay $1,000 for this bond. You have signed up for a yield of 1%. Now, if the yield immediately changes the day after you buy this bond and it falls to 0.5%, you now have a bond which is giving you more interest in terms of a coupon than the newer bonds which will be selling the day after when the yields have fallen. Investors will flock to your bond because it's more attractive, and the price of this will go up to the extent that the effective yield with the new price is equal to 0.5%, which is the new yield the day after. It will not go up anymore because at this point, investors are indifferent. Similarly, if the yield went from 1% to 2%, now you suddenly have a bond which is not giving you a coupon a coupon which forms a yield at the price you paid for yesterday at 1,000, which is sufficient to be competitive or attractive in the market where yields are now higher. For it to be competitive, you will have to sell this bond at a discount, and the price must go down such that the coupon rate and the face value give you an effective interest rate, which then becomes 2%. You won't have to go price it any lower than that because then you will become more competitive and you don't need to do that. We're hearing a lot about interest rates right now. Interest rates over the last 10 years globally have been on a decline, and since the GFC too. As a result, many capital markets and fixed interest markets have been propped up. Interest rates are also used for boosting GDP and creating economic activity. This seesaw relationship is quite attractive sometimes for investors, especially investors that are worried about disaster scenarios or scenarios when GDP might be falling and their consumption or ability to spend might also fall. In such a scenario, if interest rates do indeed fall, which are often pushed down by central banking authorities, bonds rise in price. So bonds have this innate counter-cyclical aspect, sometimes, not all the time, which make them attractive to investors relative to other asset classes. Because they're attractive for this reason, typically bonds have lower returns. They are defensive assets, not as low risk as cash, slightly more risk, but again, slightly more return as well over the long term. Now we'll move on to equities. Equities, shares, and stocks, all the same thing. Equities are shares in publicly listed companies. This means that by buying an equity in a company, you effectively own a proportion of that company. An investor who owns one share in a company with 100 shares owns 1% of the company. Listed equities trade on a stock exchange, such as the NZX or the NYSE or the NASDAQ. Proportional ownership, as I said, you become an owner of the company, not a loaner. When you buy bonds or debt instruments, you are not an owner of the company. Therefore, legally, you're only entitled to the coupon and the face value of the amount that is promised to you at maturity, as we talked about before. As an owner of the company, you are then entitled, if you buy shares, you are then entitled to any residual profits that the company decides to distribute. And you also typically have a vote, depending on the type of share you own. Historically, equities have generated greater returns than bonds. The reason for this is that they are riskier on average. To invest in something riskier, an investor requires greater returns. This means that asset classes that are typically riskier are priced lower, and therefore equivalent distributions generate greater returns. Mark Twain has a very witty quote in which he talks about equities and the speculation that is often involved when investing in equities. He says, October, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. Now, what he's really talking about is the risk involved in stocks. There is risk. If you look at the characteristics of a universe of equities, it's much more volatile than bonds. It's a bumpier ride, but it's a steeper ride. And what that means is over a longer run, you can expect to get greater returns. Now, we've talked about the returns on cash. These are just small coupons and interest payments. We've talked about the returns on fixed interest, which is coupons and any small capital gains or losses which may occur over the life of the coupon. Where do the returns on equities come from? The returns on equities are the sum of any dividends that are paid out by the company you have bought a share in, and any capital gains or losses. Capital gains or losses are rises in the value of the stock. The stock might rise in value if now the company is seen to be more profitable or expected to be more profitable than it was when you bought the stock. Losses work the same in a capital sense, except in the other direction. Capital gains relative to fixed income and cash typically are a larger component of the total return profile relative to dividends. This is why equities are considered riskier than bonds. For example, many companies don't even pay dividends every year. But why would an investor invest in the stocks of these companies? Well, to participate in the capital gains. I've talked about an example of what can create capital gains, but there's a range of factors that exist. We talked about profitability expectations, but there's also economic growth. Instead of being company specific, it might be that the entire market is expected to grow, and therefore, by investing in any companies within the market, your shares are also expected to grow in profitability, and therefore you get a capital gain. There are also rumors. Investing is quite behavioral. We're all people. We're not, there's a lot of research done around whether or not people are really Homo economicus, or the rational man, as is talked about in academic studies. And we've now come to a compromise in academia in which many academics now accept or acknowledge that there are behavioral effects which cause inefficiencies. Rumors or behavioral biases can also create capital gains and losses, and they can't reasonably be explained by quantitative or rational factors such as profitability or growth. Now, just to give a bit of flavor on what the asset class risk and return profiles look like. If you think of a distribution of the potential returns that can be generated as well as the midpoint, we see that the distribution of cash, which is represented by that gray line, is quite narrow. It doesn't have a wide distribution, which means there are a few outcomes which can reliably be predicted or forecasted. But as a result, due to the lower, the less wide distribution, the expected return of cash, which is the midpoint of that gray curve, is lower than fixed interest in equities. On the other end of the spectrum are equities, which have a much wider distribution of outcomes. What this means is it's more likely for a wide range of outcomes to occur in the return space of equities. Equities might return 20% tomorrow. They might return negative 20%, whereas something like cash is probably only going to return at the most 5% next year, or at the least negative 3%, all hypothetical numbers. As a result, though, for equities, if you were to draw a line in the middle of that blue distribution, you would find that the midpoint is further to the right and therefore a greater expected return than fixed interest and cash. Now, what this means is, given a small horizon, you might actually get a much lower return by investing in equities than you would in cash or fixed interest. But if you repeat this game many times, eventually the expected return of equities will be higher than cash and fixed interest. Now let's look at what's actually happened historically. If you were to invest $100 into either cash, NZ bonds, or global equities in 1988 and hold this position till the end of 2017, what would your portfolio look like? Well, the dark blue line at the bottom is cash. Over this horizon of 30 years, your $100 would have amassed into $710, which is not too impressive. But there is low risk. That line is very flat. There is not much volatility, which is the bumpiness of the line. And it's steadily rising and becomes 7 times higher than what you started with, roughly. The light blue line is fixed income, and you would end with $1,040. Now, we do see some bumpiness in that line. There is a little bit of risk. You may be selling at a relatively low point, or you may be selling at the top of a market cycle. But if we look at those cycles for that universe of NZ bonds, we see that the curvature or the bumpiness is not that much. So the cost of selling at the bottom relative to being at the middle is not too bad. The last asset class, and potentially the most noticeable, is global shares. Now, if you invested $100 in 1988, you would now have $2,180, 21 times as much, which is quite attractive. But what's not attractive is the bumpiness. Now, we don't know if we're selling at the trough, at the bottom of a trough, or the top of the market until the next day. As a result, we wouldn't know if we were selling at potentially a low point or a high point, as indicated by the bumpiness of that graph. This is a good representation of risk. Markets go up and they go down, but on average, over a long enough period, you will be better off by investing in equities relative to fixed interest and cash. The question here is, how long is long enough? And what's going to happen when you really do need the money? If you need the money and you're in the bottom of a trough, it may be that your portfolio isn't worth as much as you'd hope for it to be. This is risk. Now, I just want to talk about what we look at Russell Investments in terms of a typical conservative, balanced, and growth portfolio. Now, you may have heard the terms growth assets and income assets. Typically, we combine various asset universes into what we consider to be a growth asset universe and an income asset universe. This is useful because it groups together all the risky assets, such as equities, into one portion of your portfolio, and all the less risky assets that pay regular income streams, such as fixed interest and cash, into another portion of your portfolio. The growth and income portions of your portfolio can then easily be communicated to one another to give a general flavor of what the portfolio looks like in terms of risk and return. Now, what we've got here on this table is a picture of what a typical conservative, balanced, or growth portfolio might look like. On the top half, we have weights. Conservative portfolio, we recommend 20% in growth assets and 80% in income assets. A balanced portfolio is 50-50, and a growth has three-quarters of its exposure in growth assets, 75%, and the remaining quarter of 25% in income assets. The growth and income splits can then be further disaggregated, so we see what's really within the splits. In these portfolios, we have global equities hedged and unhedged, New Zealand equities, some global listed infrastructure, which is an asset class we haven't talked about. And in the income assets, we've got global and New Zealand fixed interest and cash. Now, without going too much into the numbers, on the bottom, we see some risk and return metrics for these portfolios. You can see that the nominal return per annum, we forecast to be much lower for conservative portfolios. They have more of their money in income assets. 2.1% for conservative, 3.6% for balanced, and 4.9% for growth. The trade-off there is lower risk. Risk is often measured by volatility, the standard deviation or the range of outcomes that can happen around the midpoint expectation. The volatility per annum as we forecast for conservative is 3.6%, dramatically increasing for balance to 7.7%, and then 11.3% for a portfolio which has 75% invested in growth assets. Now, I'm going to talk a little bit about alternative asset classes. These are ones that are a little bit harder to put into growth or income categories. These require more specialized investment knowledge and don't have a lot of the factors that we talked about earlier in that traditional asset classes typically do. Typical alternative asset classes are commodities, which are materials or resources or goods which are traded, such as steel, oil, wool, coffee. Direct property. This is owning property individually, not owning property through a fund which invests in property. Investing in hedge funds, which often have very varied strategies and are difficult to clump together in one group. Or private equity. Private equity involves investing in equities or stocks of companies that are not listed on a stock exchange. The trade-off here is that there's a lot less information, it's a lot less liquid, but as a result may generate superior returns over the long run. Recently, private equity funds have come under fire for not performing to expectations, But going forward, whether that will continue to be the case is anyone's guess. So the desirable features of some alternative investments include low correlations with traditional asset classes. Why do we want low correlations? Well, what do correlations really mean? Correlations are how much the returns of asset classes or different investments move together. The greater the correlation, the more perfectly you can draw some sort of line which would map out the returns of each asset class. For example, if you had two stocks which were perfectly correlated with a correlation of 1 with each other, that means if you knew the returns of one of the asset classes, you would know what the returns of, one of the stocks, you would know what the returns of the other was without having to do any guesswork. If they had perfectly negative correlation, a correlation coefficient of -1, you would also know the same, except it would be a negatively sloping line. An asset class with low correlation is typically one which has correlation around 0. As an investor, you want correlations to be more centered towards 0 or negative of the assets that you invest in within your portfolio. This creates something called diversification, which we'll talk about later. The less correlated your investments are, the better it is from a perspective of portfolio efficiency. Portfolio efficiency is the trade-off of risk and return. We really want to be optimizing that trade-off, meaning having the greatest possible return for a certain level of risk, or having the lowest possible risk for a certain level of return. Low correlations are what allow that to happen. Alternative investments also give are expected sometimes to give superior or satisfactory long-term returns to compensate for this additional risk of not knowing what the valuations are, of not having a liquid asset class to invest in. They also have reasonable volatility, which is used, or is a factor, I should say, of generating these satisfactory long-term returns. Some other considerations of alternative asset classes include management fees. These tend to be higher, especially for hedge funds and private equity. Liquidity is lower for some of these alternatives. Again, private equity and hedge funds particularly. Product availability. So there aren't that many competitive products relative to traditional asset classes for these alternatives. There's also a bit of a fiduciary burden. Investors need to know what they're investing in when looking at alternative investments. They should not assume that they will behave the same as traditional asset classes. And there is a lot more due diligence that is required in this sense. We now move on to portfolio construction. We're going to be talking about risk and returns, starting with returns. Where do returns come from? Well, oftentimes investors get bogged down into the nitty-gritty of which stocks to be in, or what constituents or what stocks do their fund managers hold. But really, the majority of returns come from the strategic asset allocation. The strategic asset allocation is the split of a portfolio into the various asset classes. It is the target exposure that is rebalanced back to when thresholds are exceeded. We talked about typical strategic asset allocations when we looked at the growth, balanced, and conservative portfolios. The reason a strategic asset allocation drives returns is that the difference in risk and return profiles of the different asset classes is much greater than the difference within these asset classes. What this means is if you were to look at a couple of stocks within global equities and look at the difference between the risk and expected return profile, it can be pretty big. But usually the difference between those two stocks and the difference between global equities and global bonds, the latter is going to have a wider range, or a bigger variation, I should say, in risk and return. And therefore, deciding how much to invest in bonds and equities is a bigger question than which specific bond or equity to invest in, and will drive the majority of your portfolio's volatility and return and performance. Having said that, active management should also be considered. Deciding which stocks to be in can lead to a benchmark being outperformed or underperformed. Consistent out or underperformance can generate substantial and significant superior or inferior performance. So it's not something to ignore. Market timing is also an important consideration. When should we be in a certain asset class? Should we be changing our strategic asset allocation or tilting it to a tactical bet that we think will pay off as investors? If we get this bet right, we could potentially earn a lot of money. If we get this bet wrong, we could lose a lot of money. An example of this would be an investor who had a 50-50 portfolio, very easily split between bonds and equities earlier this year. If timed correctly, and with hindsight, of course, that investor could have tilted their portfolio further into equities at the bottom of the market in March following the COVID fallout. However, this isn't easy to do. The future is very difficult to know. And just as it's difficult to pick the correct stocks within a universe, it can also be difficult to pick universes. Now, we've talked about what the strategic asset allocation is. It's the proportion invested in the various asset classes. It explains roughly 90% of your performance. If you get the strategic asset allocation wrong of your portfolio, but you're picking the stocks right within those allocations, you're still probably going to have very poor outcomes. And the reason for this is the stock selection or the bond selection or the security selection within universes is really generating superior or inferior returns at the edge or the fringe, almost, you can say. The strategic asset allocation determines the majority of your portfolio's performance. And again, I emphasize is the key decision that an investor should be spending the most time making, and typically will be used to attribute the performance of your portfolio relative to other portfolios. Now, I've talked about risk a few times. I'd like to properly define what financial risk looks like. Financial risk depends, the definition of financial risk depends on the investor or what the investor is worried about. Having said that, typically within the industry, when we talk about financial risk, we're talking about the volatility or the forward-looking probabilities of things that could happen. Now, as we see in this distribution, the volatility is the range of outcomes around what we expect. The expectation is that middle average point there. Everything around that in the distribution are things that we don't necessarily expect but could happen. An investment with a wider curve, a wider distribution, is typically more volatile. On average, you're going to get something that you didn't expect more likely, more often to occur. This is risk, the chance of something unexpected happening, and the impact of that unexpected outcome in terms of returns. Sometimes investors think of risk as the chance of loss. Now, that's the potential for returns to be less than 0%, the orange shaded portion on the left. This completely depends on a number of factors and can be a little bit more difficult to model. The chance of loss, having said that, can still be modeled using various tools, such as a VAR, a value at risk. Now, the greater the financial risk, or the greater the distribution, the wider the distribution, the further right, typically, the expected return is. How does that work? Well, if you've got a wide distribution of returns, you know that something very unlikely could happen relative to another investment where it's never going to happen. You wouldn't want to invest in that first investment with the wide distribution. As a result, you price it down as an investor. You are reluctant to invest in it and will only do so if it's sold to you cheaply. By buying a cheaper investment, you then generate a greater return when you do receive that dividend as a proportion of how much you've spent to buy that security. So we've talked about risk, and we've talked about risk generating greater expected returns. Why do we not load on as much risk as possible? Well, as an institutional investor, it's not about maximizing returns. It's about meeting an objective. Remember, you don't want risk. Risk is the trade-off that you have to live with when you take greater returns. Risk is also the potential of missing your target or not meeting your objectives. An investor should only take on as much risk as is necessary. You want to create a portfolio which is efficient and is expected to deliver the objectives that you require, at the same time minimizing the risk. Let's talk about diversification. Diversification, that line doesn't perfectly line up, but that's okay. Let's pretend it does. Diversification can be thought of as the only free lunch in finance. If we were to graph risk and return on these two axes as so, we would see that New Zealand bonds have lower risk and lower expected return, and global equities have greater risk and greater expected return. So a portfolio represented by the green circle on the left that is 100% invested in New Zealand bonds would be somewhere down to the bottom left, whereas a 100% invested portfolio in global equities would be somewhere up to the top right, represented by the blue circle. However, we can combine portfolios of create a combined portfolio in global equities and New Zealand bonds, which sits somewhere between those two circles. If New Zealand bonds and global equities were perfectly correlated, meaning that they perfectly moved in unison with one another, and they had a correlation of +1, an investor would only be able to invest in a portfolio on that gray line at some end of the spectrum or within the spectrum. If you look at each unit of expected return for each unit of risk, we see that that line has a constant slope. What that means is to take on more return, you have to take on more risk. To get one more unit of return, you have to add on the same amount of risk, no matter where you are on that line. So this is where a hypothetical 50-50 portfolio would be if there was no diversification. However, we talked about correlations before, and very few securities actually do have perfect correlation with each other. Bonds and equities are quite attractive because they tend to have quite imperfect correlations with each other. As a result, we get something called the efficient frontier. Now that's that orange curved line that extends above the straight line. Without getting into the maths, and there are statistical proofs for this isn't just intuitive, when you combine securities or asset classes which are imperfectly correlated to create one portfolio, what you do get is a weighted average of the return, meaning a 50-50 portfolio would just be 50% of the expected returns of bonds and 50% of the expected returns of equities. But you don't get the weighted average risk. You get slightly less. So what this means is with imperfect correlation, if we wanted that 50-50 portfolio and we wanted that same expected return, we could go off to the left with that arrow there and get much less risk. Or we could keep the same risk and get much more expected return. This is diversification. This is why it's important to combine uncorrelated investments. You reduce a lot of risk for free, and you can create more efficient portfolios which maximize the return to risk trade-off or optimize. Now, diversification will never get rid of all of the risk we see there. So you still need to have some risk. The remainder of this risk is what we call systematic risk. This is the risk that cannot be diversified away. And typically it's this risk which generates returns. Investors can't get rid of this risk, so they have to be compensated for it. Now we're going to move on to the peripheral considerations. We're going to be talking about currency management. So far, we've quite naively been talking about returns in various asset classes, but as a New Zealand investor investing overseas, the total return we get is the return of that asset class plus some sort of currency effect, depending on if the New Zealand dollar goes up or down. If the New Zealand dollar goes up, an investment in a foreign currency is now actually worth less in New Zealand terms, and the New Zealand investor loses. If the New Zealand dollar goes down, the investor wins. This is called currency risk. An investor investing in an unhedged overseas product is exposed to currency risk. It is possible to largely remove currency effects through hedging. What hedging is entering into a contract in order to exchange currencies at a given rate in the future. These typically reflect the relative interest rates of the two countries, but we won't get into that because that can get complicated. It's possible to remove currency effects using a hedging contract, but at the same time, you may, depending on which country you are converting the currency from, lock in a lower exchange rate than the spot rate or the rate that is currently in the market. You can also lock in a forward a premium or a higher exchange rate than the spot rate or the current market rate. It all depends on the two countries' interest rates, but the advantage of doing so is you know what you're locking in, and therefore there is no risk around this. Hedging also sometimes has additional management fees or additional transaction costs, but typically these days these are much smaller than they were in the past. Should we hedge or should we not hedge? Well, investing overseas and hedging your investments, you don't make or lose money as a result of currency movements. You remove currency risk. But you have to keep in mind, as an investor, you might end up regretting an investment if the hedged return is less than the unhedged return. Exchange rates are notoriously difficult to forecast. Russell has written a few papers on this, and I encourage you to look into these. These should be available on our website. Exchange rates can be quite difficult to forecast, and as a result, may not be worth the time or effort in doing so. Passive and active management. What is it? Well, passive funds are easier to comprehend. We talked about benchmarks before. Benchmarks are universes that are created into hypothetical portfolios, which are considered an index or a benchmark of that universe. For example, US stocks, we all know what the S&P 500 is. New Zealand stocks, the NZX 50. These are benchmarks. They reflect the New Zealand or US equity universe, and they're used to measure at a broad level what that universe or how that universe has been performing. Passive funds track these indices. They attempt to replicate the benchmark by holding the same stocks or similar stocks or bonds or cash products, depending on what the benchmark is, and achieve the same returns. This is sometimes known as beta or just investing in the market. Because there is relatively less effort in creating a passive fund and there are less active bets or active risk, management fees are also typically lower for passive funds. By investing in a passive fund, you are broadly investing in the market that the benchmark is trying to track. You will never beat the benchmark, but you won't underperform the benchmark either, gross of fees. Active management is slightly different. Active managers aim to outperform the index. Now that says active equity managers, but you can still get active managers, and you do still get active managers in all other types of asset classes, including fixed income, but also alternative asset classes like commodities or hedge funds or private equities. The skill required for an active manager is security selection. Within the universe, the active manager needs to determine which securities are likely to outperform and which securities are likely to underperform relative to the benchmark as a whole. What the active manager then does is overweights relative to the benchmark those securities they expect to outperform and underweights those they expect to underperform. Now, not every active manager can consistently outperform. There is some skill and some luck involved in the returns from an active manager. What's important from an institutional investor is manager selection. The investor must spend a significant amount of time deciding on which manager they believe, as a result of their belief set created in the strategize section of the framework, is best fitting their belief set, like I say, and is likely to outperform on a variety of metrics. Active managers also typically have higher management fees. So investors need to be taking into consideration the gross of fees returns, but also the net of fees returns. What is their portfolio actually worth after the active manager subtracts their fees? Oftentimes, active managers may outperform the index gross of fees, but once these fees are taken out, the index beats the active manager's portfolio. I'm going to move on to single or multi-manager. Now, because of the difficulty within choosing active managers, it can also be difficult to identify the managers who consistently achieve an alpha. Alpha is outperformance or excess returns in excess of the benchmark that they're trying to beat. It's difficult to find an active manager that consistently gets their outperformance target. What an investor might do is to use a number of good active managers or blend their exposures to multiple active managers. This is called a multi-manager approach. We believe at Russell Investments that this should be able to produce a more reliable alpha over any given time period. It's quite similar to diversification. If a single manager has some form of style bias, investing in a multi-manager product which has multiple single managers, the single managers can then the correlation and the style exposures of each individual single manager nets off to some extent, and it creates a more efficient portfolio from a correlation and risk and expected return perspective. Now, we often hear that past performance is no guide to the future. Here's a good example for why. Some research that Russell Investments did in 2012 looked at data on active managers. We found that the first quartile, or the top 25% of active managers, only 22% remained in the first quartile going forward. 24% moved to the second quartile, 33% now moved to the third quartile, and 22% were in the bottom quartile. That bottom quartile would mean that managers that earned the top 25% returning managers within their universes then became the worst 25% managers in the following period. If you had invested in that top 25% just believing that past performance would generate returns into the future, you would be very unhappy in the following year. Now, just to give an illustration of single versus multi versus passive managers, here is a distribution of the returns in alpha space, so meaning relative to a benchmark, that passive, single, and multi managers are expected to achieve. Now, a passive manager is expected to achieve 0 alpha on average, meaning that they are never going to earn anything higher or lower than their benchmark. Now, the reason there is a slight distribution there, very narrow, is sometimes there may be errors. Some passive managers don't perfectly replicate what their benchmark holds because it's quite costly to do so. Typically, this is in fixed income. And as a result, try to replicate the returns without holding everything. And this can create slight differences in the return profile of the passive product. A single active manager is typically expected to create some alpha, some positive excess returns. Otherwise, why would you invest in them? Having said so, there is a distribution of returns, and they may actually end up in negative alpha territory. However, if we take a multi-manager approach and combine multiple good active managers, we can get this tighter distribution, which has a similar alpha, but less risk, like the correlation example we talked about earlier. Thank you for tuning in, everybody. This concludes this webinar. Again, my name is Mihir Tirodkar. I work at Russell Investments. I've left my contact details here. feel free to get in touch if you have any questions around the seminar or further questions around capital markets. I hope this was informative to you and will add value in your investment process going forward. Thank you.